The world of real estate investing has become far more accessible in the digital age. Gone are the days when you needed huge amounts of capital or hands-on experience to break into the market. Today, you can invest in real estate from the comfort of your home using online platforms. From real estate crowdfunding and REITs, which are real estate investment trusts, to online marketplaces that allow you to buy rental properties or shares in real estate, there are endless opportunities for beginner and seasoned investors alike. In this detailed guide, we'll cover the top 3 ways to invest in real estate online. You'll learn how these platforms work, what types of investments are available, and the potential risks and benefits. Ready to take your first step into online real estate investing? Let's get started. Real estate crowdfunding platforms, a gateway to property investing. In the last decade, real estate crowdfunding has become one of the most revolutionary methods for investing in property. These platforms allow investors to pool their funds together to finance real estate projects, making it possible for anyone to own a piece of real estate with a relatively small initial investment. Instead of buying an entire property, you own shares of larger projects and receive a portion of the income generated or profits from the sale. How real estate crowdfunding works. Real estate crowdfunding platforms such as Fundrise, RealtyMogul, and CrowdStreet let individuals invest in everything from residential apartments to commercial office buildings. Here's a breakdown of the process. First, sign up. Investors create an account on the platform of their choice. Next, browse investment opportunities. Each project listed on the platform provides detailed information, including the type of property, projected returns, risks, and investment terms. Then, invest. Depending on the platform, you can start with as little as $500. The platform pools your money with other investors to finance the project. Finally, earn returns. Over time, you'll receive dividends from rental income or profits if the property appreciates and is sold. These platforms usually have different types of investments. Types of crowdfunding investments. Equity investments. With equity investments, you own a portion of the property itself. The returns come from rental income, and you'll also share in any profits when the property is sold. Equity investments are riskier because they depend on the success of the property's performance, but they often offer higher returns. Debt investments. In a debt investment, you're lending money to a real estate project. You earn interest as the borrower repays the loan. Debt investments tend to be safer than equity, but the returns are generally lower. If the project fails, debt investors are repaid before equity investors. Advantages of crowdfunding. Low entry barrier. Unlike traditional real estate investing, which requires large sums of money up front, crowdfunding allows you to get started with as little as a few $100s. Diversification. With crowdfunding, you can spread your investments across multiple properties, reducing risk. Hands-off management. The platform handles all aspects of property management, including tenant relations, repairs, and selling the property. Risks and downsides. Liquidity issues. Real estate crowdfunding is typically a long-term investment. Once you invest, your money may be tied up for several years, depending on the project. Platform risk. Be cautious of which platform you choose. If the platform itself runs into financial trouble, it could affect your investment. Market risk. Like any real estate investment, your returns depend on the performance of the real estate market. If property values fall, so do your returns. Real estate investment trusts, REITs, a stock market approach to real estate. For investors seeking a more liquid and traditional approach to real estate investing, real estate investment trusts, or REITs, provide an excellent solution. REITs are companies that own, operate, or finance income-generating real estate. When you invest in a REIT, you're buying shares of that company, and in return, you receive dividends from the property earnings. How REITs work. REITs operate much like mutual funds. Investors buy shares of a REIT through stock exchanges like NASDAQ or through online platforms like Robinhood and E*TRADE. The REIT uses the collected funds to buy or manage a portfolio of properties, including shopping malls, office buildings, hotels, and apartment complexes. As these properties generate rental income or increase in value, the REIT distributes the earnings back to its shareholders. One key benefit of REITs is that they are required by law to distribute at least 90% of their taxable income to investors as dividends, making them an excellent option for those looking for consistent income. Types of REITs. Equity REITs. Equity REITs own and manage income-producing properties. These REITs generate income primarily through renting or leasing properties and by selling them at a profit. This is the most common type of REIT, mortgage REITs or MREITs. Instead of owning properties, mortgage REITs invest in real estate loans and mortgage-backed securities. Their income comes from the interest on these loans. While mortgage REITs can provide high dividends, they are more sensitive to interest rate changes, which can make them riskier. Advantages of REITs. Liquidity. Unlike direct property investments, REITs can be bought and sold on the stock market, making them a more liquid real estate investment. Low capital requirements. Investors can buy shares for as little as a single stock price, often less than $100. Dividend income. REITs provide a reliable source of income, with regular dividend payments that are often higher than most stocks or bonds. Risks of REITs. Stock market volatility. Since REITs are traded on public stock exchanges, their prices can fluctuate with market conditions, even if the underlying real estate is performing well. Interest rate sensitivity. Rising interest rates can negatively affect REITs, especially mortgage REITs, as borrowing costs increase and dividends become less attractive compared to safer investments like bonds. Investing in real estate through online marketplaces. If you're looking to directly own properties without the hassle of managing tenants or taking out a mortgage, online real estate marketplaces offer an exciting way to buy properties entirely online. These platforms allow you to invest in rental properties or fractional shares of a property from anywhere. Buying properties on platforms like Roofstock. Platforms like Roofstock let investors purchase tenant-occupied single-family rental homes. You can browse properties across various U.S. markets, review the financial details, such as rental income and expected cash flow, and complete the entire purchasing process online. Once purchased, you become the owner of the property, earning rental income without the need for hands-on management. Roofstock and similar platforms often provide property management services, handling tenant relationships, repairs, and rent collection. Fractional property ownership. If owning an entire property seems too daunting, you can invest in fractional ownership through platforms like Arrived Homes and Loftium. Here you can buy shares of a rental property for as little as $100, allowing you to earn passive income from the rental without owning the full property. Fractional ownership also provides a way to diversify your real estate investments across different properties and locations. Diversifying across markets. One of the key advantages of online real estate marketplaces is the ability to invest in properties outside of your local market. Whether you're looking to buy in a high-growth market like Austin, Texas, or invest in cash flow properties in more stable regions, these platforms offer access to markets you otherwise couldn't participate in. Advantages of online marketplaces. Access to data-detailed property reports including expected cash flow and historical performance help investors make informed decisions. Diversification, easily invest across different regions, property types, and markets. Hands-off management. Most platforms offer property management services, meaning you can earn passive income without having to deal with tenants directly. Risks of online marketplaces. Management dependence. If the platform's property management team is ineffective, it could affect your returns. Liquidity issues. Selling your ownership stake or fractional shares may not be immediate, and you might have to wait for a buyer or a specific sale period to cash out. As you've seen, investing in real estate online offers a variety of opportunities for both beginners and seasoned investors. Whether you choose crowdfunding platforms, where you can get involved with just a few $100s, REITs, which provide liquidity and consistent dividends, or online marketplaces, where you can directly own or co-own rental properties, there's a strategy that can fit any investor's needs. The key to success is research and understanding the risks involved with each method. If you're looking for a hands-off approach, crowdfunding and REITs might be your best bet. For those who want more control and are ready to buy properties outright, online marketplaces offer a flexible entry point. Remember to like, subscribe, and hit the notification bell for more tips on real estate investing and personal finance. Let us know in the comments which strategy excites you the most, and which one you're most interested in trying. Thank you for watching and see you in the next video.